Welcome back, guys. I hope you're doing good. Today we'll discuss about what it looks like before a depression starts. Have you ever pondered what life was like right before a major economic depression struck? It's a captivating thought, understanding how a society can transition from thriving to facing bad times in the blink of an eye. The fascination with understanding the dynamics leading to an economic downturn and the abrupt transition from prosperity to crisis has been a topic of interest for many. In this video, we will explore the signs and factors that preceded depression, shedding light on the historical patterns and economic theories that help us recognize these warning signals. Before we start, make sure to hit that subscribe button and ring the notification bell. Gaining insight into the economic pain just prior to the onset of a depression is crucial for every individual. So let's delve into what it looks like right before a depression starts. The economic dynamics leading to boom and bust cycles are driven by fractional reserve banking and central planning rather than free market activity. Let's break down the concept. The boom phase. In a small isolated economy, a bank introduces lending services, generating new paper money without physical backing. This practice enables the bank to lend money at lower interest rates, enticing borrowers and stimulating economic activity. Borrowers invest in various sectors, creating a facade of prosperity as the borrowed money circulates. This artificial boom leads to price increases, presenting an illusion of thriving economic conditions. However, the boom is often underpinned by unsustainable levels of debt and misallocation of resources. The bust phase. As borrowers start repaying their loans, the boom reaches its zenith and the bust phase begins. The banker faces two options to address the impending crisis. Option 1. Lower interest rates again, restarting the cycle. Lowering interest rates once more restarts the boom-bust cycle, pushing the economy to even greater heights. Rather than paying off existing debt, borrowers continue to accumulate more debt, leading to increased money supply and economic growth. Eventually, this strategy results in hyperinflation and economic collapse as the currency loses value. Option 2. Raising interest rates, forcing deleveraging. To prevent further financial damage, the banker can choose to raise interest rates, deterring new borrowing. With new borrowing limited, existing debt must be repaid, causing an automatic deleveraging process. However, this path, like hyperinflation, unveils the misallocation of resources and triggers economic pain. The outcome. During the boom, economic decisions are made based on false information generated by artificially manipulated interest rates. It's during the bust phase when the consequences of these decisions are exposed, leading to a reckoning of the misallocation of resources. Recognizing the boom and bust cycle is essential to comprehend the patterns that precede economic depressions. Effects on society and individuals. The boom and bust cycle isn't just a financial phenomenon, it has a profound effects on society and individuals. As the boom takes hold, people experience a sense of false security and growing wealth. During this time, consumer spending tends to increase as people feel more financially comfortable. However, when the bust phase arrives, there is a sharp contrast. People who have been living off credit find themselves in the dire straits, struggling to pay off their debts. And businesses that have overextended themselves face tough decisions, often leading to layoffs and downsizing. Moreover, economic depressions can have a long-lasting effect on mental health. The stress of losing one's job, home, or savings can take a heavy toll on individuals and families. How it plays out historically. To get a sense of how this cycle has played out historically, let's take a closer look at a few notable examples. The Great Depression, 1929. This is perhaps the most famous example of a massive economic depression. It began with the stock market crash of 1929, which was the culmination of the Roaring '20s boom. The subsequent decade saw massive unemployment, widespread poverty, and significant societal changes. The 2008 financial crisis. The financial crisis in 2008 had its roots in the boom of the early 2000s, when housing prices surged, driven by easy access to credit. When the housing bubble burst, it led to the global financial crisis. The impacts included foreclosures, bank failures, and a global recession. By reflecting on these historical examples, we can learn valuable lessons and apply them to our current situation. It's not just about recognizing the signs, but also understanding the broader social and psychological impacts of economic downturns. AI boom, economic prosperity. The adoption of artificial intelligence is undoubtedly transforming various industries, and investors have already witnessed the stocks exposed to AI outperforming the market significantly. However, there is a growing concern that the enthusiasm around AI might be pricing in too much optimism. High valuations with trailing price-to-earnings ratios of around 50 often signal market euphoria, reminiscent of the dot-com bubble in the late 1990s. It's crucial to acknowledge that the potential of AI is far from fully realized. While AI can boost productivity across sectors like banking, energy, healthcare, and retail, the automation and augmentation of tasks might lead to an alarming increase in technological unemployment, much like its structure unemployment observed during the Great Depression. As AI becomes increasingly integrated into our lives, it's essential for both policymakers and investors to consider how to harness its benefits, while mitigating potential economic and labor market challenges. By doing so, we can navigate the transformation and the transformative power of AI with greater foresight and resilience. Signs of an impending depression. So what are the signs that we might be on the verge of an economic downturn today? Inventory buildup. We see signs of inventory piling up, particularly in the automotive industry. Car prices, once surging, are now being slashed as inventory accumulates. Luxury item price drops. Even luxury goods like Rolex watches are experiencing price drops, indicating economic hardship. Housing market struggles. In this housing market, high mortgage rates make it difficult for homeowners to sell, leading to a prolonged period of high costs for those looking to rent or buy. Credit card delinquencies. Credit card delinquency rates are on the rise, a sign that consumers are struggling with increasing interest rates. Banking issues. Banks are tightening lending standards, which typically occurs before a recession. Several U.S. banks are exceeding the FDIC's guidance on the concentration of commercial real estate loans. Stock market valuations. Stock market valuations are at historic highs, typically preceding market downturns. These signs suggest that we may be on the brink of an economic downturn. To navigate these challenging times, it's crucial to be financially prepared and consider strategies that can help grow your wealth amidst economic uncertainty. Economic policy and government intervention. In times of economic uncertainty, the role of economic policy and government intervention becomes critical. It's essential to examine how fiscal and monetary policies are being implemented and their potential impact on the economy. Fiscal policy. Governments often adjust their fiscal policies to stimulate or stabilize the economy. This can involve changes in taxation, government spending, and budget allocations. It's crucial to assess whether the government is implementing fiscal policies that support economic growth or if they're adopting austerity measures. Monetary policy. Central banks, such as the Federal Reserve, play a pivotal role in managing the money supply and interest rates. Central banks might raise interest rates to combat inflation or lower rates to encourage borrowing and spending. Understanding the direction of monetary policy and the central bank's stance can provide valuable insights into the economic outlook. Government intervention. Keep an eye on government initiatives and stimulus programs. These actions can either boost economic activity or lead to increased government debt. Evaluating the balance between economic stimulus and long-term financial stability is essential in gauging the overall economic health. By considering the influence of economic policies and government interventions alongside the existing signs of an impending depression, viewers can gain a more comprehensive understanding of the economic landscape and be better prepared for the future. Preparation and resilience. In conclusion, understanding what it looks like before a depression starts is only part of the equation. Knowing how to prepare and build resilience against these economic challenges is equally essential. Individuals can consider several steps such as managing debt. Reducing personal debt levels can provide financial stability during challenging times. Diversifying investments. Diversifying investments across different asset classes can mitigate risks. Savings and emergency funds. Building a robust emergency fund can provide a financial cushion during unemployment or economic crisis. Financial education. Educating oneself about economics, investments, and personal finance can help make informed decisions. Adapting to changing conditions. Being flexible and adaptable in the job market, developing a new skill, and exploring multiple income sources can enhance financial security. By taking these measures and staying informed about economic conditions and government policies, individuals can navigate economic uncertainty more effectively and strive for financial security even during challenging times. Thank you for joining us today as we explored what it looks like before a depression starts. Stay informed, stay prepared, and keep striving for financial well-being. Share your thoughts and ideas. How can we prevent a Great Depression-like situation due to the economic downturn? Don't forget to hit that subscribe button and ring the notification bell for more insightful content.